Have you ever looked at a company and just wondered, are they really doing as well as they seem? Well, today, we're going to pull back the curtain. We're going to decode the language of business by diving into the three core financial statements that show you what's really going on. Right, so when you see a massive company, how can you tell if it's actually a powerhouse or if it's just really good at looking like one? To get past all the hype and the fancy marketing, you've got to look at its financials. That's where the real story is. The easiest way to think about these documents, they're basically a company's official medical checkup. No fluff, no spin, just the hard facts about its financial condition. And just like a doctor, we're going to run three key tests to get a proper diagnosis. First, we're going to take the snapshot, which gives us a perfect picture of the company's health at one single moment. Then we'll watch the movie to see how it performed over a period of time. And finally, we'll follow the cash story to see exactly where the money came from and, more importantly, where it all went. All right, let's dive into our first test, the balance sheet. We call this the snapshot for a reason. It doesn't tell you about last week or what might happen next month. Nope. It freezes a company in time and shows you its exact financial position on one specific day. The whole thing is built on three main parts. First, you've got assets. That's all the stuff the company owns that has value. Then you have liabilities. That's everything it owes to other people. And finally, shareholders' equity. You can think of that as what's left over for the owners if the company sold all its assets and paid off all its debts. Take a look at this example. You can see that perfect balance right here. On the left, we've got all the assets, things like cash, inventory, even money that customers still owe the company. That's called accounts receivable. On the right, you see how all that stuff was paid for. Liabilities are debts, like a bank loan or bills they owe to suppliers. That's accounts payable. And the rest is the owner's stake, the shareholder's equity. And here's the magic. See how both sides add up to the exact same number? They have to. This brings us to the golden rule of accounting. Assets must equal liabilities plus shareholders' equity. It has to balance. Think about it. Everything a company owns had to be paid for somehow, right? Either with borrowed money, which is a liability, or with the owner's money, which is equity. It's a perfect system. One last thing on the balance sheet. You'll see the words current and non-current. This is actually super simple. Current just means short term. Think less than a year. So current assets are things you expect to turn into cash soon, and current liabilities are bills you've got to pay this year. Non-current is just the opposite. It's the long-term stuff, like a big factory or a 10-year loan. Okay, test one is done. We've seen the snapshot. Now it's time to roll the film with our second test, the income statement. Unlike the balance sheet, this isn't about one moment. This tells the story of a company's performance over a whole period, like a quarter or an entire year. The whole point of the income statement is to answer one single, all-important question. Over this period, did the company actually make any money? It's all about profitability. And the logic is really simple to follow. You start at the very top with revenue. That's all the money the company brought in from selling its products or services. Then you subtract all the expenses, the cost of actually doing business. And what you have left at the very end? That's the famous bottom line. That's your net income, your profit. So, what kind of stuff gets counted as an expense? Well, pretty much everything. The cost of the raw materials to make a product, salaries for your employees, what you spent on that big ad campaign, even the paper for the office printer. All of that gets subtracted from the revenue to find out if you're truly profitable. And that brings us to our third and final test, the cash story. This is the cash flow statement. And honestly, this one might be the most important of all. It doesn't care about accounting rules. It only cares about one thing, cash. It answers, where did the cash come from and where did it go? Now, this is a really, really common misconception. You might think that profit is the same thing as cash, right? Wrong. The answer is a huge no. You can have a company that looks super profitable on paper, but if they run out of actual cash, they can still go bankrupt. And that is exactly why this statement is so critical. What this statement does is kind of amazing. It basically strips away all the fancy accounting stuff and just shows you the movement of cold, hard cash. It doesn't matter when a sale was booked. It only matters when the money actually hit the bank account. It's the ultimate reality check. To make it easier to read, it breaks all cash into three buckets. First, operating activities. This is the cash generated from your main business. You really want this to be a positive number. Then there's investing. This is cash spent on big, long-term things, like buying a new building. And finally, financing. This is cash from investors or banks, like if you take out a loan or sell some stock. So there we have it. We've run all three of our tests. We've seen the snack shot, we've watched the movie, and we've followed the cash story. But none of them work alone. To get the full diagnosis, you have to see how they all connect. You see, each statement gives you a different piece of the puzzle. The balance sheet shows you if the company is stable. The income statement tells you if it's profitable. And the cash flow statement shows if it can actually survive and pay its bills. You absolutely need all three to see the whole picture. And here it is, the aha moment where it all clicks. That net income, the profit we found on the income statement, it doesn't just vanish into thin air. It flows directly over to the balance sheet and gets added to a line called retained earnings. That's literally just the pile of profits the company has kept over the years. So performance over time directly changes the company's financial position today. It's all connected. So in the end, it really does all come down to this. Financial statements are the official record. They cut through all the noise and tell the true, unvarnished story of what a company is doing and how well it's performing. So now you have the tools. You know how to read a company's official health report. You know how to check the snapshot, watch the movie, and follow the cash. The only real question left is, the next time you look at a company's financials, what kind of story are you going to uncover?